sector's Upclose. I'm Elena Casas. Today, we're talking hard times for big tech with Amy Kong of Barrett Asset Management. Last week, Facebook parent Meta Platforms announced it is to lay off 11,000 staff after disappointing guidance wiped out a quarter of the company's market cap. It's the latest in a long line of Silicon Valley layoffs. Amazon announced about 10,000 roles will go, most of them on its Alexa project. Elon Musk is cutting about 10% of jobs at Tesla, along with about 3,700 Twitter employees as he took over that company and took it private. Crypto firm Coinbase has cut around 1,100, while there have also been four-figure layoffs at Snap, Shopify, Stripe, Lyft, Microsoft and Netflix. The reason for some of these is obvious in the stock performance. This is the S&P Communications Services Index, home to a number of those companies and the year's worst performing sector. So what's gone wrong in Silicon Valley? Let's ask Amy Kong of Barrett Asset Management. Amy, hi. Why do you think we're seeing so many layoffs in tech companies in recent days? Did they just hire too many people during the pandemic, or has something worse gone wrong?
Hi, Lena. Thanks for having me. I think it's a bit of both. There's clearly a lot of overhiring during the pandemic. Clearly, there's a lot of trends that were in favor of some of these large tech companies. To give you some perspective, Meta's employee base grew 26% from September last year through September of this year. And we saw similar growth rates for Microsoft as well as Google. Really, the only company that didn't hire as many people was Apple. And so you are seeing a bit of a reversal of that overhiring. But I think in general, these tech companies are leading the way in preparing for a potential recession. And this is not atypical. We definitely have seen this before, where larger companies start to right size, if you would, their labor force. And that's exactly what we're seeing today.
Do you think then that tech is a kind of canary in the coal mine? If we see advertising spending on social media dry up, the rest of the economy is likely to follow?
You know, I think as long as I think you're right. I think some of these tech companies are more cyclical. You know, take Meta as an example, but there are some companies within that mix, like Microsoft, for example, that still have a very strong core business, and so those companies haven't gotten hit as hard, if you would, and so there's likely to be a divergence, if you would, between some of those companies that are a lot more cyclical and spending quite a bit on some of these other things, whether it's metaverse, if you would, or AI. And you still have some very core companies that have recurring revenue, free cash flow generation still very strong. So I would say there's likely to be a balance between the two.
You mentioned Meta's metaverse. Google also is investing heavily in augmented reality. But do you think investors have faith that these companies have worked out what the next technology will be that could make them money?
I don't think so. I think it's a great question, and I don't think investors are believing that these next legs of growth, if you would, have materialized. I mean, take Meta as an example. They just kept pouring money into this whole metaverse. But what I think investors have been concerned about is the core business is also slowing. And we saw something similar with Google to an extent, Disney too. I mean, we saw a lot of that. And I think that's where the market is being very sensitive, is when your core business is not growing and you're constantly spending on some of these other things. I think that's the major concern that I would imagine investors are, again, baking into the stock prices.
But these stocks are a lot cheaper than they were a year ago. So when do they become good value? Are we getting there?
That's a tricky question, Elena, and it's a relative one. Right now, I think in the short run, you've got a lot of sensitivity towards where the Fed funds rate will ultimately land, and these stocks will be very sensitive towards that point. And so, unless we start to see the Fed hint that they will again get to a point where they're going to stop raising rates, I think there's likely to be still some volatility with this group. And it's a relative call in terms of how much of a value proposition they are at the moment, again, all based on the macro factors in the short run.
Given everything you've said, Amy, how should investors be approaching the sector at the moment?
Sure. As I mentioned, I think the short run, will be very sensitive to where the terminal rate will be. And so really it's more of a macro question, but longer term though, as I mentioned, the fundamentals remain important part of our portfolios. And we still like the companies that have the pricing power, the brand premium. And so we're very mindful of that, but we're probably staying away from some of the cyclical type tech names for the time being.
Well, thanks so much for joining us, Amy Kong, CIO of Barrett Asset Management. Well, that's our roundup of big tech. I'm Elena Casas, and this is Reuters.